But let's get to the latest news. The Consumer Price Index is out now, and it shows inflation rates slowed down last month. The CPI is up by 8.5% from a year ago, easing slightly from the 9.1% seen year over year in June. The core inflation rate, which excludes food and energy prices, went up 0.3%. Let's bring in Lori Bettinger now to break it all down. She's the president of BancAlliance, a network of community banks. She's also the former director of the U.S. Treasury's Troubled Asset Relief Program, which was established to stabilize the economy and prevent foreclosures. Good to see you.
Great to see you. And I have to say, we're going to be discussing all of this with my inner soundtrack of Stop in the Name of Love going through the back of my mind. So
such a classic. Such a classic.
It's not a bad inner soundtrack to have.
That's right.
I know.
Anything Motown.
It's not at all. It's just a sign of a good day.
So let me ask you about these latest numbers. What do they tell you as an analyst about the state of the economy? Are we moving away from a potential recession? And I know that there's been debate by economists. You know, historically, I spent 20 years on the street, 2 consecutive quarters of low GDP, negative GDP. Low GDP signifies a recession, but there are others who are saying we're not just there yet. So what do you make of it?
Right. I think, this is a good sign, and it's clearly inflation moving in the right direction. We were hoping it would come down from this 9.1% last month. It has. You do still see a slight increase in core inflation, right, which is everything except for food and energy, which tend to be really volatile. They move around a lot. I mean, gasoline, I think, is one of the, the drop in the price of gas that we've all, seen recently is one of the things driving down this number. But it is nice to see this moving in the right way. And it doesn't really feel like we're in a recession right now. I know everyone's arguing over how do you define recession. I feel like last year we were arguing over how do you define transitory when people were hoping inflation wouldn't stay around. But, this feels like a good report.
So we know a lot of the reason that we've seen sort of prices go up has to do with the price of gas, which has dropped. But that's not the only reason. There have been supply chain issues and other things sort of causing hiccups. So can we expect consumer costs to continue to drop?
I certainly hope so. But it's, we're in this world where we think we sort of found a new steady state and then something comes up, whether, it's a supply chain, whether it's geopolitical, whether it's a new public health issue. But it feels like, across these different things, the world has stabilized slightly. And we are seeing, prices come down in some, really specific areas. But I still think there's a lot of pressures. And it's hard to see, the average American consumer feeling, less of a burden on their wallet in the short run, because we're still seeing so much higher prices than we were. And sometimes prices go up much more quickly than they can come down.
So will these numbers have any impact on the Federal Reserve's rate hike plans?
It's a great question. I think we're going to continue to see rising interest rates. Maybe this doesn't sort of cause, I think if this number had come out even higher than last month, I think we would have seen it in a very unhappy stock market. Everyone would have really anticipated continued and these big interest rate increases. But, we still have inflation. I think we've heard from the Federal Reserve consistently that it's too high. They're going to take whatever steps they need to manage that. So I think the time of interest rate increases is going to continue, I think, at least throughout this year.
So we've been sort of talking about Main Street. What about Wall Street? How do you anticipate Wall Street to react?
I think that they're going to be happy about this. I would think that, they would at least, this would be considered a good day. It's hard to know right now. Sometimes it's a good day for 20 minutes and something else comes along. But this generally seems like a positive report to me. And I would expect that, that Wall Street would look at it similarly.
So as you know, high inflation has forced many, many families to spend more than usual. How is this impacting credit card debt? And I guess the question for a lot of people on their minds is how can they lower that debt?
Right. That's a great question because, as you point out with credit card debt, that's something that really can be quickly affected by rising interest rates because, some debt is fixed. It doesn't change after you take it on, but credit card debt is variable. It changes as the interest rate goes up. So, I think that people are going to have to sort of make the decisions they need to if they see, that credit card balance still costing more every few months. I think we will see cutbacks in certain areas as people, maybe cut down a little bit on both goods and services to make sure they're able to pay that credit card debt. So far, I don't think we've seen a lot of increased delinquencies. We heard in sort of the recent bank stock reports, that people were feeling good about the health of the consumer. But, the credit card debt is one of the first places you're going to see these rising interest rates and the impact on the negative impact if you're a consumer.
Lori Bettinger, thank you very much.